So when you start your company, it's all excitement and optimism. You're going to fundraise, you're going to build a product and grow the business, but things don't always work as planned. And for quite a few startups, they run out of money. It's very sad and it's very traumatic and it's very stressful for everyone, in particular the founders. And at SeedLegals, we see companies asking us, what do I do? I'm out of money. How do I close the business? And the good news is there's now a platform to help with that. So today I'm going to be talking with Toby at Close Easy. Now, Toby's here not to pitch Close Easy, but to help with advice. So when things don't work out, to help you have a less stressful way to close your business and see the options that are available to you. What happens with SEIS? When can you just go on Companies House? When do you have to have a liquidator and more? So Toby, thank you so much for, spending some time to help founders everywhere, both with the business and on this video. So tell us a bit about your background and what got you to start Close Easy.
Thanks very much for having me, Anthony. Good to be here. My background is, as you know, I was founder of Foodstuff. We were going great guns for 4 years, but then the economy changed. We hit some tough challenges and decided to wind our own company down. So as a result of that, I felt the aches and pains from a founder's experience of going through closing their company, a solvent liquidation. So very happy to be here and offer a bit of a helping hand to maybe other founders that have got going through it or have been through it or would like to educate themselves of what that looks like should that situation arise for them.
Okay, so thank you. Now let's talk about the different class of closing companies. Some of them you've got money still in the bank, some of them you don't have money but you don't have creditors, some of them you've got people that are unpaid. Walk us through the main things and then we'll get on to what your options are in each case.
Yeah, sure. So I think the first option is not to liquidate. You can mothball it, leave it dormant, and not much needs to happen. This might be a founder's option if they want to leave things flexible for the future. Perhaps it's a market downturn and the possibility of it working in the future might come back. So they just basically drop tools, stop trading, leave everything live, but not operational. Second one is an MVL, which is what I went through, and I imagine what a lot of SeedLegal founders will go through as prudent founders. They'll have cash in the bank, and they're basically just realizing those assets and looking to distribute what's left.
MVL stands for?
That's members liquidation, members voluntary liquidation.
Okay.
And yeah, sorry, go on.
And do you have to appoint a liquidator? Can you just close the company on Companies House?
You will have to appoint a liquidator for that.
Yes. And okay, we'll get into the pros and cons of each. Okay.
And then there's a creditor's liquidation where basically the IP would also, the insolvency practitioner would also have to be appointed and they're representing the creditors. So you're in an insolvent position where you haven't got money to distribute to your shareholders as well as pay creditors.
Okay, so these are basically the three options that you have.
There are worse options as well. There's a CVA. Well, there's a CVA, which is there. You have creditors to pay, and it is salvageable. It's recoverable. So you might want to look at ways to pay your creditors over a longer period of time. And then there's an administration where you're in serious financial problems, where it's probably a little further along.
Okay. So before we get into the pros and cons of each, let's start with the director's responsibilities.
Yeah.
So I think this is the biggest problem space for founders who are directors of the business, because I think you are criminally liable if the business trades insolvent.
Yeah.
But you live on hope as a startup, right? You're hoping often to do a new funding round, and it's the collapse of the funding round or the time taken for the round. And now you're not sure, like, okay, I've got like 3 months of burn rate, and then it gets lower and the fundraising isn't working. So do I immediately have to close the business? Do I have to fire everyone? Walk us through what you see the choices are, and at what point the writing is on the wall that living in hope isn't really going to work anymore.
Yeah, totally. It's a really difficult challenge. And as a founder, you're kind of programmed to keep going. So to have that moment of it's over is a hard one. And because we tried so hard for so long, it was actually a moment of relief in the end for us, where having that kind of next step was useful. But most founders will know what their headroom is. And all I'll say is keep that division in your mind of once you've paid off all your creditors, What's your headroom after that? And how much will it cost for you to wind down your business? Quite often you'll be in contracts with partners that have 3 months notice. All of these kind of things you really need to understand so that you know what your bank balance will be at the end of when you appoint your liquidator and you start to distribute.
Okay, so let's now go through the different options. So let's start with, in a sense, the best option, which is, you cut all your costs to zero, you've got some money in the bank, and you just leave the company. There's no need to close it. So you now need to manage this with investors to explain why you're doing the You're not going to see a return on investment.
Yeah.
You probably need to reset their hope expectations. Maybe they think it will pick up again later. You need to reset your own hope aspirations, because at some point the clean break, if you're not getting a day job because you're hoping this is going to come back again, but you're not putting in, it's not going to come back again. Then there's the SEIS, EIS for the investors, because if the business doesn't work out, I think, your first responsibility after making sure you don't lose your house is to help the investors get their SEIS and EIS loss relief.
Yep.
And if the business is just sitting there, then they may not be able to claim. So is there anything you can do to help them claim? Can you give them a nil value valuation and so on? Or do you have to go to one of the other steps to help them get their SEIS loss relief?
So if you were to apply to put the business into dormancy with Companies House, SEIS and EIS would be negligible. It'd be redundant. So that's something you would need to speak about with investors. And I think most founders that put things into a dormant position, it's either such a small amount of cash that maybe investors or shareholders are not incentivized. They don't necessarily mind. But also it might just be because they have a real belief that it will come good one day. So if it is a black and white, it's over, perhaps mothballing isn't the best choice, particularly as EIS and SEIS are not eligible in that position.
Okay, so now we go to step 2, which is you don't have unpaid debts and so on, but you now call in an administrator or liquidator. How much does it cost? Who are you going to call? Can people go on Close Easy and find one?
Yeah.
How can you help?
Yeah, so there'll be a number of insolvency practitioners in the UK that range all kind of prices. If you've got 3 shareholders, which a lot of SeedLegals clients probably will not as a result of what you guys do, it can cost $1,000. Real quick, distribute, and it has to be done by a licensed practitioner. If you've got 50 shareholders like we had, there's a little bit more admin involved, which means it costs roughly $5,000 that would just come off the amount of money that gets distributed to shareholders during that process.
Okay, so that seems like, obviously if you're about to run out of money, $5,000 is quite a lot, but it's not enormous in the scheme of things, and it sounds reasonably simple in that case. So let me ask a question, which is, the company's now got some intellectual property. There's a domain name, there's some code. How does it work with the founders owning it? The founders would probably go, well, I'd love to, no one's going to be doing anything. Can I get this code? Can they just keep the hard drive? Do they have to assign it to themselves? And then we'll get on to, can they start another company doing the same thing later on?
Yeah, so first things first, it's on the founder to try and do his best job for their shareholders. We spoke about duty as a director. If you can sell anything as an asset, that attempt should be made, whether that be your brand, whether that be tech, IP, and all the IP will do, the insolvency practitioner, once they get a hold of your case, is just sanity check that cost and that value is representative of that product that you're selling.
So let's say I've raised £300,000 from investors, and at the end I go, I'll pay $3,000 for the assets. Does the insolvency practitioner have to look for competitive bids, or do they just go, well, I've got nothing else on the table here, I'll take your $3,000?
Speaking in my own experience, we sold some assets through our network, and they didn't compete or challenge that at all. They just checked that it wasn't a ludicrous price like 1 penny, and shareholders were going to dispute that down the line.
Right.
But if you can get the job done, usually it reduces the cost and labour cost for them, so it's mutually pretty positive.
Okay, so now let's jump to, can I do the same startup again? So this is something I see periodically at SeedLegals for 2 reasons. One is I've closed the company, but I want to make a new one. And the other one is I've had a company, it's okay, it's been running for 3 years, I've now can't raise SEIS anymore. Can I just close that company and make a new company doing essentially the same thing, but for so I can raise more SEIS. So let's talk about reusing the trading again under the same name and so on. Now, my understanding is that if you close down voluntarily, subject to your shareholders and so on being okay, you could start a new company with the same name. But if it's insolvent, involuntary liquidation, then you can't. Tell me the rules on that.
I'm not an expert on this,
right?
Actually, and I think because it was, in our experience, it was so clear that we were always going to do a members voluntary liquidation. In essence, you could sell your IP to another director and start again. I'm not sure what the conflicts would be there. But this isn't something that came up for us, being honest with you. It's not something we had to contend with.
Okay. All right. So the one thing that I do know, because we'll see it frequently, is people trying to circumvent the 3-year SEIS trading rule by going, I'll close this company, I'll make another one.
Yeah.
Doesn't work. HMRC just look on Companies House at all those companies you're a director of and go, you know what? There was Fish Smart over here that you were doing, and now you're doing Fish Smart too.
Yeah.
It's the same SIC code. It looks from the website. It's the same from your last SEIS application that we've still got on record.
Yeah.
A new one looks the same. So it's called a continuation of trade.
Okay.
And, if you do create a new company, you probably won't be able to raise SEIS in that company because HMRC just treat it as
the same company.
Particularly if you've raised SEIS in the previous one. They've gone, taxpayer money has gone to create this code. You can't do the same again afterwards.
Okay.
So be aware of that. Okay, so let's now jump to scenario number 3, which is you really have run out of money and you owe money to people. Does this disqualify you from being a director in the future? How bad is it?
So it doesn't, on the face of it. And once you've appointed an IP, they then represent the creditors and just do the best job for the creditors. So, you'd hope you're not in that position. At the very least, you'd want a CVA, which means that you are profitable, but you just need to buy time for cash to be distributed to creditors. If you go past that, essentially, the insolvency practitioner will help you sell assets. They'll help you shift things to and maybe restructure things to create liquid cash to then distribute and pay off creditors, rarely in full.
Right. And how much does that cost?
So that's usually more because there's litigation, there's forensics, there's more narrative involved. And I'm now learning more about it, spending more times with insolvency practitioners. I'm very glad I didn't go through it. Seems like quite a scary time for a director, to be honest with you. So I think that's probably 7.5 to 12.5 as a bracket. So definitely more labour costs for the firm, and they definitely look under the hood in a lot more detail.
Okay. So to the extent if you are closing the business, let's get on to employees and so on.
Yeah.
So at some point, your cash is dwindling. At what point can you terminate your employees? I know this is employment law and you may or may not, be able to be an expert on it, but to help to the extent we can, founders, what are the rules?
The best way to do a members voluntary liquidation is by getting everything done before speaking to the insolvency practitioner if you can. And by that I mean receive money from your debtors, pay off creditors, and make your employees redundant so that you really understand your cash position, and then you can get into PAYE, VAT, and all the other corporation tax pieces. That means you get a really quick net position for the IP to work from.
Okay. So going back to the first one, where you leave the company dormant, there are certain things that may not be entirely by the book, but may be possible. So one of them is, you may be eligible for R&D relief from the government. So maybe you've got £50,000 or £20,000 or £100,000. If you shut the company, that's all gone. If the company is no longer going concern, I think it's gone.
Yeah.
But if the company's in the, we've cut costs and we aspire to come back again, it might be on the okay side. And now maybe as the founder, you can reach an arrangement with your investors that you'll help them get their SEIS and so on. But in return, they'll let you put any remaining R&D cashbacks that come back into the company, and that could be distributed to you potentially, or it could be used to resuscitate things potentially if that was still a good idea.
Yeah, it's my understanding, because we were in a similar position here where we had to decide whether we were to pursue R&D, and any founder right now knows how long that takes. And we decided not to, but we did learn that if you did apply and you were successful, you are still, you can still accept those and they are still yours post-liquidation. So that is quite an interesting thing. And obviously the kind of laws and the approach from the government now on R&D is a lot tighter than it used to be. I think there were quite a few chances in that space, so it really does have to be unique and special IP in order for the claim. But yeah, I think that should definitely be part of your headroom equation in order to understand what your position is before winding down the company.
Okay, so everyone understands, let's dive into what Close Easy does. So you're a platform that isn't available as a founder. Don't go to closeeasy.com because there's nothing for you. But if you're an IP insolvency practitioner, instead of running your business on spreadsheets or Microsoft Word or something silly, there's now a modern platform for that. Is that right?
Absolutely. So there's quite a few components to getting appointed, which means you can put companies into liquidation, and that is doing AML, IDV checks on shareholders and directors. It's getting signatures on lots and lots of documentation, and then there's loads of data capture points, up to 50 of files and Q&A basically, that all of which determine A, what liquidation it is, and B, enables them to move things through the flow. And that is currently in an archaic state, usually over email, lots of calls, letterheads and all this kind of stuff, and wet ink. We've built one link that you can do it all in a white label portal that saves admin teams on the IP side a huge amount of time, but also lets that industry come into the 21st century and have a digital first client experience for founders like myself and others going through that.
Okay, so any words of wisdom or advice as either somebody who's closed the business or somebody who now sees the way the industry works to help founders that might be in this tough position?
For sure. Well, I think as you will be prudent with your finances for shareholders, just make sure you know what your bottom line is. And your bottom line is you probably want to know what your resting bank balance should be where things are uncomfortable. And I think if that looks under 3 months and there's no round on the table after paying creditors, after your kind of wind down cost, I think you want to move pretty quickly. And I absolutely don't think there's any harm in having an insolvency practitioner that your accountant introduces you to now, so you can have a bit of a game plan ready that means you can move quickly should you get to that state.
I think that's wise words, and I think also what founders would be looking for is some sort of playbook. Here's when you can reasonably start a redundancy. Here's how long it's going to take. You know, there's no point waiting to have 30 days cash in the bank. If the wind down process is going to take longer, I mean, if your employees are on 30 days notice and it's going to take some time to set that up, and some of them might be on, longer than that because they've been with the company for a while, and there's holiday pay, and now actually the 30 days isn't long enough. You have to have started that beforehand.
Totally. And also, speaking from a founder's perspective, you should really know your equitable position, because the way a member's voluntary liquidation works is that your equity within that business represents how much cash you would receive out of that distribution. So your own personal headroom is worth knowing. You've spent 4 years of your life slogging it on a company that sadly hasn't gone the way that it should have done. So for you to fully understand your own personal position with you and your co-founders, to understand how soon will you need a job, how much time will you have being able to pay rent after your business closes, really, really valuable information. Because let's say arbitrary number, you've got 100K and you've only got 10% of that, that will determine how soon you would want to liquidate the company for your own personal well-being.
It's a really great point. So, if you look in your company's articles, it will say on a sale or dissolution of the company, the proceeds of sale or the insolvency amount or the remaining assets will be distributed, pro rata to the number of shares held, which means as a founder, let's say it's an early stage company, the two founders own 40% each, and the company's got £50,000 less.
Yeah.
So they're going to get, £20,000 each. The investors may or may not like that because it's the investors' money that is now going primarily to the founders. On the flip side, particularly if you've raised from a VC and they've got preference shares, they might say, the investors get repaid first. So the investors put £1 million in the business, that 100,000 you're seeing nothing of, that's going straight back to the investors.
Yeah.
So these are super important things to know, not only at the time you want to close the company, but the time you did your funding round in the first place, so you know what happens if the business does well or doesn't do well.
Yeah, absolutely. And I think and this is why it's such an interesting, if you look at a member's voluntary liquidation in practice, you could technically do it after 2 months of raising 3 million quid. I mean, it seems a little bit bizarre. But I think what my experience was that having wound down a company 5 years into that journey, that shareholders are incredibly supportive. And we raised 3 million through your platform, angel investors, not VC. And no one really won out of it. But they were all really conscious to make sure that we had, 2 months or 3 months salary in the bank or whatever when we wound the business down, so that we weren't out in the world on our arse, basically. And I think that's what's really important for people to understand, is that not only have you got to do your director's duty, but you do also have to really understand your personal position too, and be totally transparent and upfront with your shareholders. I think we spoke to our shareholders maybe 12 months before we actually appointed a liquidator about the various scenarios of which the business may go through. And we found that a great deal easier later when we were never dropping bombs. It was a consistent open book. So that would be a bit of advice I'd definitely recommend.
Okay, so thank you. And, I agree, putting it into two compartments. Legally, we have to do these things, but actually the real thing is the emotional managing of yourself and your investors. So I think for investors, they're going to fall into two groups. Experienced investors know the rules of the game. A good fraction of startups are not going to make it. And, they're playing a betting game overall. If it didn't work, the numbers are not in their favor, but it's nothing personal. The problem is if you've taken money from friends and family, or you've made representations, guaranteed, 5 times return on investment in 3 years, and you've oversold it, and then that doesn't work out, then you end up with a mismatch that the investor's expecting something they shouldn't. So the things I have seen and would really recommend founders focus on is, I think, and it matches what you've said, if investors see that the founders tried everything they could to make it a success and they're not profiting personally from the misfortune, then investors, with few exceptions, will be sympathetic and go along with it and help with anything they can. And in particular, if you can show that they'll get their SEIS loss relief, and you'll put your own time and effort into making sure that that's the case. However, if you have been dishonest with investors, it's going awesomely, shit, we're out of money. But your last report 2 weeks ago said it was amazing. Or they see that suddenly the domain name, the source code, the patents or whatever all sit with you, and you pop up again later without consultation. This is going to make for unhappiness. So I guess, emotionally, if they see that their pain is your pain as well, then with few exceptions, I think they would be supportive. And the things that you need to get them to decide to buy into, approve, you can do. So the managing of that's really important.
Absolutely. And there are things they need to sign. And if they don't sign them and they're not cooperative, that makes your life a lot harder. So obviously that's not your only motivation to being good to your investors. They've supported you. So, monthly, quarterly updates are important. But I think when the business goes through rocky periods, which they always do, I think just be super proactive at keeping them in the loop, really, because when it comes down to it, they have to be quite heavily involved for things to move quickly.
Okay, so then the last thing to cover very briefly is your team. So, you got your team to follow you on your journey. They gave up jobs elsewhere. And the problem is, if you start sharing, 12 months earlier, we're losing money, we can't fundraise. My last 5 investor meetings went terribly. Everyone, come back. We need you to build the product. Don't leave. So, but on the flip side, hiding everything, it's going awesomely. Sorry, we can't make payroll this month, is highly unfair. And, it's really difficult to find the right balance between keeping a team motivated and on board when things are, as a founder, it goes up and it goes down. If you shared every bit of bad news, no one would be around tomorrow. On the flip side, you don't want to cross over into being duplicitous or dishonest. And then at the end, people go, you knew this was coming, but you didn't tell me, and now I've just bought a new house and so on. So any thoughts on, how to manage that process?
Yeah, totally. So we spoke to our team in a very similar way we spoke to shareholders, and actually quite often had them in the update. So it provoked conversation and took them on the journey too. And we only spoke about these things within scenarios, and there is always good scenarios as well as bad scenarios. And obviously for good scenarios to be unlocked, these things need to happen. And if they don't happen, these scenarios that are slightly more negative are unlocked. And we felt that actually with a small team and a brilliant team, they were able to take that information on. And during the hiring process, we were pretty transparent about where the startup was, that we weren't profitable, that we're a very small fish in a very big pond trying to shake it up and be disruptive. And in a similar way to how an angel investor knows that it's a high risk investment, I think all employees should know they're also getting into a situation that is also high risk. We tried to take them along the journey as quickly as we possibly could. And we also kept them up to date on likely redundancies and made sure that we never missed a payroll as a result of that, because they were always we always knew what that would cost and what we wanted to award in terms of redundancy, so that we could work back from worst case.
Okay. And I think that open and honesty with employees is good. And I like the sharing the different scenarios so people can make their own decision. Should I buy a new house and have a mortgage, or should I hold off on that? Because, as long as payroll is met, the worst case, I'll be unexpectedly out of a job. But there are many reasons for being unexpectedly out of a job. And I'll be competing in the workforce for a new job, but I haven't got some liability that I wasn't planning on.
Startup employment insurance as well is a good little tip as well for people who want to be in a fast-paced, high-risk environment, but know that things don't always work out.
Okay.
Founders can't do that, sadly.
Right. Thinking top tip. All right. Thank you so much for sharing the knowledge, wisdom, and experience so that others have an easier journey when things go well or when they don't go well.
Absolutely. And if there are any founders listening, please don't hesitate to reach out. I'm very happy to.
Where can they find you?
So just head to my LinkedIn, it's Toby Savill, or drop me an email at toby@closeeasy.co.uk.
All right. Thank you so much, Toby.
Cheers. Thanks a lot, Anthony.